Robschild, no investment advice. Welcome back to the show where we view financial markets using technicals, macro, and Benjamin Graham's investment philosophy. And crystal ball gazing. Today is Thursday, October 3rd, 2024. Today's episode will start by mentioning that markets were fairly neutral as expected. Market movement before a major report, such as the employment report, unemployment report on Friday, you have to assume that everything is going to its neutral spot. And so that's how we're going to interpret what happened today. On top of it, we had the holiday adding to the neutrality with lower volume than usual. Today, initial jobless claims came out for the week of September 28th. They were higher than the expected in the last reading of this, but not shockingly higher. Again, the big report that matters more than anything every month is this one, and it's coming out tomorrow, the unemployment rate. No updates on the daily reminders. If you want to hear me talk through them, watch Monday's show. Crystal ball rating remains market crash incoming, and the Fed won't cut fast enough to save the economy. I want to start with bringing up the 10-year break-even inflation rate, only because I talked about a week ago when it was down to 2.02, how we were breaking to new lows that we haven't seen for years at this point. I was kind of curious to see if we would have a lower high and a lower low, but instead we have a higher high now. And so this chart is moving sideways. And actually the last reading of this was yesterday, with the market currently pricing inflation over the next 10 years to average around 2.2%. As much as I believe TLT is a good place to be, if this continues higher, then TLT is not such a good place to be. And right now this chart is looking neutral. It's not looking like it wants to go up or down. It's kind of waiting, honestly, for tomorrow's data, I think, more than anything. One of the most interesting charts of the day is DXY, the dollar index, continuing to show even more strength than before. This is going up. Notably, nothing's really changed in the Fed funds futures to indicate that the dollar should be stronger or weaker at this point. I think this has more to do with how we have some problems in the Middle East right now, and oil, and people are kind of running to the dollar. The dollar, it's funny. You'll hear on every single show how, the safety haven assets have become. Some people say Bitcoin, but most people say gold. So interestingly, we have a little bit of a rush to dollars right now. The VIX, one of the best fear gauges out there, still climbing up today. The pricing of options contracts going up. I really don't know what the market's looking for right now in terms of the unemployment report. Again, this likely has more to do with the price of oil than anything else. With oil going up, then you have rates going up, so it's more expensive to borrow money, so it becomes less profitable for businesses. Oil going higher, oil shocks are never a positive thing. So I suspect that's the main driver of this. I've been discussing on many shows how one of my favorite speculative positions right now is to short high-yield corporate bonds for 1.5 million reasons. Credit spreads are really tight right now, which means they can only they can get a little bit tighter, okay? But typically from where we are, we would expand. We wouldn't get very much tighter, and they can only get so tight. They can't go to zero. And right now, junk bond spread is around 3%, which is very low. So if that spread were to widen, junk bonds lose value. So shorting junk bonds seems like it might be a good idea. Now, if the economy is really great, it's on fire, inflation's kicking back up, well, what happens? All yields go up, so junk bonds drop anyway. So good, if the news is good, great, bad, terrible, it doesn't matter. I think that right now is a perfect time to be short junk bonds. Just a little chart pattern thing that I noticed recently, and it's actually a divergence between HYT and HYG. Now, I like HYT for investment when the market is very low because it has more beta, so it has more potential to grow more. You get higher capital gains return than you would get it with HYG. Now, the divergence that I noticed was just in the chart patterns. We have HYT. By the way, I finally fixed my charts. If you've been following this show for months now, I have not been using adjusted for dividends charts, and that's typically, in other words, if it's paying out a dividend, it automatically drops in price. That can really screw up how the trend lines work. So sorry about that, but it's fixed now. And with that fixed, you can see more clearly the movement of this fund. I just wanted to point out that we've had now this very large engulfing candle at a top, which is typically a very, very bearish sign, followed by some consolidation. And then if we were to combine this red candle and this red candle together, it almost looks like another engulfing candle there. It suggests that when the bears take hold of the market, they're strong and there are not enough buyers to hold them back. And so they drive it down quickly. And so maybe this is the top of junk bonds. But what do I know? I'm just a guy with a crystal ball. HYG does not show such a similar pattern. Again, I think that HYT, well, it has more beta to it. So obviously, I know. I don't even have to look at the holdings. The HYT has more lower grade bonds, basically. That's how this works. As you go from, more junk status, so the lower the credit rating, the more sensitive it's going to be to its value. Whether if people have a little bit of fear, all of a sudden junk bonds, they the worst junk bonds go to the floor. And then the higher the credit rating, the less sensitive they are to bad economic data. But bad economic data can markedly affect even AA corporate bonds stronger than you might think. If you look at those, I'm not going to bring those charts up. You can look into them yourself if you're interested. You could use HYT as sort of a leading indicator of where credit might be headed, and that pattern looks pretty bearish to me. So again, nothing really matters because we got to see what happens for this Friday report and how it affects markets. It's the kind of report that could cause a Black Monday next week if unemployment is 8%, something ridiculous. Last reading of this was only 4.2, so we'll see. We'll see what happens. It's a very exciting day tomorrow for that report. As I'm sure if you're watching this show or watching any shows, oil's going up. Went up by almost 4% today because of fear of oil shocks in the Middle East. Notably, these conflicts started to really escalate back here in the chart where there were even days where we had escalations and oil was dropping on the same day. And so, it wouldn't be a surprise for this big green candle here to be a blow-off top. This does break a pretty obvious trend line pattern of going down. But is it going to show more strength here to really confirm that this is a longer term bottom in oil, or is this just a blow off top and, where it can go the other way? Again, geopolitical issues can affect, they can affect this market. And, if some news happens that they shut down this, sending oil around the world, oil is going to shoot up. So there's no way to predict. Everything's going to be fine. I have a crystal ball. K-Web broke lower. I was wrong. Gareth Solway, with all of his trading experience, knew that this level, if you scroll way out on the chart, I'm not going to, but this has a long history, this price right here, around 38.75 on K-Web. So it did act as a pretty strong resistance. And so obviously there were a lot of people that shorted. And obviously with the green candle today, that was the right time to get out of your short to, make your profit here. I suspect this will continue higher. Again, I believe that this market is still very, very undervalued until it gets at least around the $45 to $50 range would be a more reasonable, cheap price. Right now, it's kind of like dirt cheap. So for the balloon underwater to rise to the surface, I think we still have a little bit more ways to go before the fat lady sings. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.